Okay, it's time to roll up our sleeves and get into this capital budgeting analysis work. We're going to start with the very hardest thing to do. And it's not dealing with the financial measures on a calculator. It's fundamentally about just predicting these cash flows that goes into all of these analyses. Getting these cash flows right is crucial, and it's tough to do because some of them are way out there in the future. And this is predictive work here. The better we are at predicting cash flows, the more confidence we can have in our capital budgeting analysis. It's that old garbage in, garbage out routine. If we don't have good analysis, good prediction of these cash flows, when we put it into the analysis, we're going to have troubles and we're going to make poor decisions here. So, 3 basic types of cash flows. First of all is the initial cash we spend, the initial investment. Not a lot of uncertainty around this particular type of cash flow there. Not nearly as much as there is with the future flow of operating cash flows. Now, if this is a for-profit investment, these are going to be profits coming in or cash inflows. If this is a regulatory investment, an investment we're making out of compliance requirements, these are probably going to be outflows in the future, outflows related to maintenance and upkeep. Now, way out there in the future, depending on how long-term this investment is, we're going to finally unwind the investment. We're going to dispose of it. And there are often, not always, but often there's some cash inflows coming as a result of that unwinding down the road. Now, notice I've got net in front of all of these. Net of what? Well, there's going to be inflows and outflows related to selling and buying and expenses and revenues. But the biggest net effect going on there is taxes. There are tax effects taking place throughout all 3 of those types of cash flows, and we've got to understand taxes. If there's a tax rate involved in an exam you're preparing for, or a tax rate involved in an analysis you're doing in your business, and there always is taxes in that type of analysis, we need to be looking at the after-tax cash that we're actually spending and actually receiving. That's what goes into the capital budgeting analysis. Now, we're going to also define this concept called working capital. This may be familiar to you or not, but it's an important aspect of the net cash investments and the net cash from disposal. So we're going to make a clear definition and demonstration of what we mean by working capital. I want to remind you of something you're probably already aware of. Cash does not equal profit. They're 2 different things. Think about the statement of cash flows and the income statement. They're very different from each other. We need to remind ourselves of that distinction. You've got 4 different financial analysis tools. 3 of them are NPV, IRR, payback, net present value, internal rate of return, and payback. These 3 are based on net after-tax cash flows. But there are 4. And the 4th one is that return on investment tool. Return on investment is not focused on cash, it's focused on profit, on income. And so we've got to reorient ourselves when we're doing ROI and move from cash flows back to income or profit flows there. Very important. Make sense? Good. Well, let's talk about computing cash flows to begin with then. Big picture, again, 3 different broad categories of cash flows. The first one is the net cash investment. Now, I've got this in red here because this is almost always a cash outflow. There's occasionally a cash inflow involved with cash investments if there's some type of real strong tax incentive perhaps going on there. But this is almost always a cash outflow in red. So watch that to be a negative number. Now in yellow I have operating cash flows. They may be positive inflows, they may be negative outflows. Again, depends on the type of investment we have there. Just pay attention to whether that's coming in or going out. And then at the end, the cash from disposal, if there is any cash involved at the disposal point in time, it's almost always a positive number going on there. When we put these 3 together, we can think very specifically about the characteristics of each one before we put them into the analysis. And tax effects is going to be profoundly present through all of them. So let's start with the first one here, net cash investment. For instance, cash paid out for an investment may be netted against the cash received from an old investment. Now, for those of you who are real tax savvy, you might be thinking, well, like-kind exchange going on here. I'm not going to assume that I've got the tax advantages of a like-kind exchange transaction, which those transactions are pretty hard to put together. I'm assuming that I've got a cash payment for a new asset, and in the process, if I'm replacing an asset, I'm going to be receiving some cash from that old asset. And the difference between the two is the net cash that I'm putting into this new investment there. That old asset is basically an offset. So, for example, here is a net new asset, not a net, but a gross asset purchase of $100,000. And I'm going to net it off against selling an old asset, it's a replacement, that I'm going to get $9,000 for. So I've got a net of $91,000 as an investment, right? Now, where would the taxes come into play there? Which of those line items does the tax man hit? The taxes are hitting that line item. If I'm selling off an old asset, now I'm thinking about what's the book value of that asset, how much cash did I get for that asset, and was there a gain or a loss? Let's hold on to this set of numbers and run it as a demonstration now, okay? So I'm going to set up a classic type of a format here where I'm looking at a new asset purchase, the old asset sale, and I'm going to capture book value, gain or loss, and tax effects, and end up with a bottom line net cash investment amount here. So there's my $100,000 that I'm going to pay for the new investment. There's the $9,000 I'm receiving for the old investment. And let's assume a 30% tax rate. What would that look like in terms of its impact going on? So we've got the 30% happening. Doesn't change how much I'm paying for the new asset. But check out what's happening with this old asset. I've sold it for $9,000, right? But I need to pay attention to that gain or loss that could be going on there. That I've got to watch. Now check it out. I'm assuming that this old asset that I sold for $9,000 on the books has a book value of $5,000. That is to say, its original cost minus its accumulated depreciation, $5,000. Selling it for $9,000 there, assuming that 30% tax rate happening, and I've got a gain, a $4,000 gain. So I've got to pay some taxes. Very important stop point here. Now, this may be obvious to you, but it's worth being reminded of. I do not pay taxes on $9,000. I pay taxes on the $4,000, the gain. And if I've got a 30% tax rate, I've got a gain or an income of $4,000, how much tax am I going to pay? That's a pretty quick little math we're going to do there. 30% times $4,000, $1,200. That tax effect on the gain is just the gain, not the cash received, times the tax rate, and that becomes a cost of this transaction. So I'm going to back off that $1,200, and I'm going to end up not with $9,000, but with $7,800 as the net cash received from the sale. And that $7,800 is going to offset the $100,000 that I'm spending on the new investment for a net cash investment of $92,200. That's what I mean by net cash investment. I'll just take a second and look at that, make sure that makes sense. You see the gain loss, you see the tax rate, you see a book value there and a gain on that sale transaction, and I've got to pay, again, taxes on that $4,000. Got it? Let's play with this then as a loss. Let's assume now that this old asset, I got nothing for it. Zero. But it had a book value. It had an asset valuation of $5,000. That means when I disposed of this old asset and got no money for it, I get to book a loss on my income statement of $5,000. Now, that's a beautiful thing. When I have a loss that I didn't pay any cash for, it creates something positive. It creates a positive cash flow. It creates what we call a tax shield. I can take that loss times the tax rate, and that is a cost recovery. It's going to shield taxes on my income statement there. So that $5,000 loss multiplied by that 30% tax rate creates for me a $1,500 value on my income statement. Now, don't think about loss carry forwards or carry backs. We're going to assume that this project is the right kind of a size so that I can recognize the whole tax shield value in the year I file taxes, that I've got enough income elsewhere in my company that I can pick up that value. That means that instead of a $100,000 cost for this new asset, this new investment, it nets out with that tax shield to only costing me $98,500. So this is what's important here. You've got to pay attention to these two rules. They're really the same rule. You take that gain, multiply it by the tax rate, that's a cost. Or you take that loss, multiply it by the tax rate, it's a tax shield. So what was a gain becomes a cost, what was a loss becomes a cash inflow. It's kind of cool. You can remember that. Keep your eye on it. Make sense? Excellent. How you doing at that cash investment analysis? I'm ready to move on to operating cash flow analysis, but I do not want you moving on with me until you're comfortable that you understand that cash investment after-tax analysis we just went through. So go back if you need to and review that one more time until you're comfortable with it. And then we'll do this operating cash flow together. Okay? So I'm going to assume at this point that you're set and ready to go on operating cash flow analysis. So the basic format is we've got revenues and we've got expenses and we've got income. Now, I've got two different types of expenses, and you know this as a good accountant or someone trained in accounting. I've got expenses based on cash outflow, and I've got non-cash expenses. What in the world is an expense that I don't have to pay cash for? Well, the first one that should jump to your mind is depreciation. That's a non-cash expense. And taxes are rampant throughout all of this that happens on the income statement. Let's carry on with our investment and talk about some operating cash flows that result from it. Okay? So with our example, I'm going to stay with this 30% tax rate, and annually, I'm going to play with these numbers. $40,000 of revenue coming in, cash. Expenses are $15,000 a year, and depreciation is $18,000 a year. This is a 5-year investment that we're making with a $10,000 residual value. So that's $90,000 divided by 5 is where I get that $18,000 from. Before tax income is $7,000. Tax expense, which is just going to be 30% of that $7,000, is $2,100. After tax income, $4,900, a classic income statement. How do I get this from income to cash from operations? If you know your statement of cash flows, you know that little move here, the depreciation add back move. If I add back the depreciation, I'm converting the after-tax income of $4,900 to cash flows after tax of $22,900. It's a nice little move there to move between profit from operations and cash flow from operations. It's the indirect cash statement method. What's great about the indirect method, it's just got a little adjustments at the end. What I hate about the indirect method is looking down through all this, that's a long line of computations, and doing that little add back is a memorization kind of trick. It doesn't make a lot of business sense. Let me show you a different approach that should resonate with more that does make sense. Let's start with what we received in cash from operations there. $40,000 minus $15,000 is cash income of $25,000. Do I get to keep that whole $25,000? I do not. Taxes wants their share. They want 30% of that. I get to keep 1 minus 30%. I get to keep 70% of that amount. So if I multiply that $25,000 times 1 minus a tax rate, I get an after-tax cash flow from operations of $17,500 there. So that's a pretty obvious type of computation, right? Cash from operations times 1 minus the tax rate, net cash from operations after the tax bite comes and goes. Now, what else have I got though? I've got a tax shield. I've got $18,000 in depreciation. And just like we did with the cash investment approach, that $18,000 times 30% presents a $5,400 cash value tax shield. That number right there is cash that this investment creates for me every year on my income tax return. When I put those two things together, it equals exactly what it should equal, $22,900. Now you can take either approach that you're more comfortable with, whether you're preparing for an exam or taking this into a meeting and an analysis at your business. You can take the income and add back depreciation and explain how that works to the non-accountant trained colleague, or you can look at the cash flows from operations minus the taxes we pay And then this non-cash event that creates a tax shield is two separate items that comes together to form, in total, the net cash from operations after tax. Now, I'm going to move on to disposal and cash from disposal next. Do not move on with me until this makes sense to you. Either one or the other, it's best if you understand both. That means you really understand what's going on. So play with these numbers. You've got cash investment analysis down pat, and you've learned how to do cash from operating flows after tax in both those instances. The third category is the cash we received when this investment's life is over and we unwind or dispose of the asset there. So here's a basic setup. Let's assume we do receive cash, because if we don't receive cash, then this analysis is done. But in the event we do receive cash, we've got to look at the book value of that asset at that future point in time. Because that book value compared to the cash received creates either a gain or a loss. And I'm going to pay taxes or I'm going to have a tax shield to net out the actual cash from disposal. So tax effects are happening to us again. So continuing on with the scenario we've set up, still assuming a 30% tax rate, I'm going to play with the idea that 5 years down the road, we receive $20,000 and we dispose of our asset that we paid $100,000 originally. Now, you remember from the previous slide that the depreciation annually was $18,000. This is a 5-year life, and those are some numbers that I've got off on the sidelines here that I'm not going to put on the board. Makes things too busy. 5 years of $18,000, that's $90,000 of accumulated depreciation. That's where I get this book value of $10,000 right there. Now, you might say, wait a minute, Monty. You didn't pay $100,000 for that asset originally. That was netted against an older asset that you replaced it with. And so it's not $100,000 that's your depreciation, but some number less than that. Well, that's only in the case of if you're in the U.S., a 1031 section like-kind exchange. We're not going to play around with that kind of detailed tax rules. And in most cases, like-kind exchange doesn't work for us in terms of how we book the purchase. If it's not a like-kind exchange, then regardless of what I net paid for the asset, the purchase price of $100,000 is what gets capitalized to the balance sheet. And it's the $100,000 I'm going to depreciate straight line over 5 years, assuming a $10,000 residual value that I actually hit. Book value is $10,000. That was a little accounting detour. Now let's get back to this analysis. $20,000 received, $10,000 book value. I've got a gain of $10,000 and I'm going to pay a 30% tax rate on that gain. So I'm going to pay $3,000 as the tax consequences of this transaction. That means I'm netting from $20,000 down to $17,000 is the net cash received on disposal. This is actually pretty similar to some of the analysis we did when we sold off the previous old asset to get into this asset 5 years prior. So similar concepts. Take a pause. Look through these numbers. Make sure that makes sense to you. Because I'm going to give you another scenario, as I like to do. Here's the second scenario. Let's assume that rather than having a gain that I'm going to compute a tax cost on, that I'm going to have a loss because I'm going to assume no cash received. That when I dispose of this thing, I'm just scrapping it. I still have on the books a book value of $10,000, which means when I scrap this thing, when I discard it, I've got a loss of $10,000 rather than a gain. And that's a good thing when it comes to taxes. It's a tax shield. So using the same tax shield formula, I'm going to take that $10,000 loss, I'm going to multiply it by that 30% tax rate, and I'm going to create a tax recovery or a tax shield of $3,000. That means that despite the fact that I received no cash when I sold this thing, it's going to create a $3,000 cash value, and I'm going to put that into my net present value analysis, IRR analysis, payback analysis. It goes into all of the analysis work subsequently. It's part of the cash flow effects. Take a look at that. Make sure both those scenarios make sense to you. And we are in great shape on the 3 different types of cash flows that we've got to predict in doing capital budgeting analysis. You remember at the outset I talked about working capital and that we needed to be sure you had a clear definition of what working capital is and how it affects cash flows. Well, that's what we're going to work on now, this concept of working capital. Now, the traditional definition coming out of a textbook that working capital is equal to current operating assets on the balance sheet minus current operating liabilities. Or more specifically, we're talking about cash plus accounts receivable plus inventory minus accounts payable, as long as all of those assets relates to current operations. That's what we mean by working capital in accounting definition, okay? Now, let's talk about an example that makes it really resonate. If you've been with me on previous lessons, in Section C, I talked about a lemonade stand when we were doing pricing method analysis. I want to come back and talk about lemonade stands. And even if you weren't with me on that old lesson, I'll bet some of you had a lemonade stand in your youth. What do we need to operate a lemonade stand? That is, to set up and operate a lemonade stand, we've of course got to have a stand, right? A capital investment, what we spend on that stand. But we've also got to put some other things in place before we can open business. One thing we've got to do is we've got to have a shoebox with some change in there so we can make change. We've got to put some cash into that shoebox, and that cash is basically stuck in that shoebox for the whole summer. Now, yeah, it's going to be rotating through the summers we're making change, but you're going to have to keep a constant level of spare change in this shoebox in order to facilitate operations at your lemonade stand. Now, if you are a clever lemonade stand business professional, then you know that you can make more sales if you sell lemonade on credit. Don't have a quarter? No problem. I'll put it on your tab. So if you're running a lemonade tab at your stand to get more clients, that balance of accounts receivable represents cash that's also stuck in your operations. Because alternatively, you could just have them pay you cash, but instead you're going to maintain maybe $100 of accounts receivable during the summer. That's $100 of your cash that's tied up and stuck in someone else's pocket. You also have to maintain a balance of inventory, of sugar, of lemons, of ice. And you have to have such a very particular level of inventory throughout the summer, and the value of that inventory also represents cash or working capital invested into your operations. Now, there's good news to the extent you're able to talk the store into giving you credit on the ingredients and you're maintaining an accounts payable balance down there at the grocery store. That's the store's cash stuck in your business, and it's an offset. So to the extent you've got cash in the change, cash in inventory, cash in accounts receivable, minus your balance in accounts payable that represents someone else's cash, that's your working capital in this lemonade stand. And it is a real investment. Now, at the end of the summer, what happens? Well, you get to pull the cash out of the shoebox. You get to collect that outstanding balance of accounts receivable, put that cash in your pocket. You get to not have to re-buy lemons, ice, and sugar the next day, but keep that cash that would have gone into that inventory. You will have to pay back and clear off the accounts payable balance with the store. So that's the recovery of working capital there. That very much has a cash effect. It's a cash payout to get things started. It's in a cash receipt when you close down the business and you get to pull that working capital and convert it all into free cash that you can use for something else. Now, does it have tax consequences? It does not have tax consequences. You don't pay taxes when you put that kind of working capital into your business. You don't pay taxes when you pull it out. It's just your money that's tied up and unavailable to you while the business is running. That's what we mean by working capital. Where does it position itself on our three types of cash flows there? Well, let's put it into the big picture. You remember we've got cash investments, operating cash flows, and cash from disposal. That working capital at the beginning of summer with our lemonade stand is part of the investment we make into this operation. So say that's $150 worth of inventory, accounts receivable balance, spare change minus an accounts payable balance, $150 of working capital it's invested. I'm going to add that to the original cost of the stand, lemonade stand. Now going back to the example we've been playing with during this lesson, I've got a $100,000 investment in equipment, and it's running a business operation for me. The working capital, the cash, the accounts receivable, the accounts payable is a subtract, add on to that the inventory. that working capital is going to be included with that $100,000 in net cash investment. That working capital is just in stasis during the life of this investment, so it doesn't affect the operating cash flows. But I pull it out at the end. I pull out that working capital. The same amount that I put in, that's the amount that comes out. We do not depreciate working capital. We do not burn it up or use it up. It's just a constant in there. And it has a time value. It's worth more to me here than it is 5 years later when I get it back down there. So I need to put it into my analysis. Now, while I'm on operating cash flows, I want to do one more topic with you here in this lesson. And that is distinguishing between operating cash flows and income flows. They're not the same thing, as you remember, that we talked about at the outset of this lesson. And this is about return on investment. ROI measures are using income flows, not cash flows there. And to remind you what ROI is, return on investment has some synonyms. Return on assets, ROA, return on invested capital, ROIC, or accounting rate of return, ARR. These are some of the synonyms that are attached to this general concept of ROI. Return, 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 return. That word return is income. The income that we are earning on top of the asset that we've invested. That's the concept of return on investment. And if you've studied Section A of this part of the course, then you've learned about all these financial ratios, including the DuPont formula. You would have talked a lot about ROI. It's a really important financial analysis tool, and so it gets used a lot when doing capital budgeting analysis. So there's the basic math, income over the investment. Generally, we're talking about the income that we're expecting to see in the very near future, the first year of income, and the current or initial investment that we've made here. That's kind of a naive way to measure return on investment, because this return, for the example that we've had, is going to last for 5 years. And to the extent income is going up and down over 5 years, I really want to look at the average income over the 5 years and the average book value on my balance sheet. That asset is going to be depreciated, and it's going to decline in book value during its life on my balance sheet. This thing is about what my income statement looks like on the numerator and what my balance sheet looks like as a result of what's happening on the denominator there. And that really gets at why we care about ROI in capital budget analysis. Why do we look at something that's not based on cash? Well, if I'm a publicly held company, or if I've got an outstanding loan with a bank and they're paying attention to my financial statements, this ROI is capturing how this capital investment presents itself on my income statement. It's all about looks. How does it change how my income statement looks to my investors or to my creditors? How does it change how my balance sheet looks to my investors or to my creditors? That's a reality that we've got to pay attention to if I'm publicly held or I've got institutional debt in my company. That's not the same as cash performance. NPV, IRR, and payback, and we're going to learn about these subsequently, are focused on cash flows, and that's the actual performance of this investment and how it builds economic value in the organization. So ROI is tracking on how the investment looks. NPV, IRR, and payback tracks on how the investment performs for us. Sometimes those two very important aspects are in tension with each other, and we've got to make trade-off decisions about choosing one type of investment over another, depending on how one looks on the financial statements and how it performs, in fact, with respect to cash flows. Make sense? I hope so, because it's a very important distinction that a savvy business professional and a savvy business student needs to pay attention to when they're doing this type of analysis. Analysis is complicated work. It is, again, the core of what we do as business professionals, making decisions that are both strategic and operational, and involves a number of stakeholders that are interested in how this particular investment performs with respect to their needs and expectations. Good. Well, that wraps up our lesson. Let me just mention a few items I want to be sure are clearly in your notes that you're going to take away from what we've done together today. First of all, cash flows are key to NPV net present value, IRR, or internal rate of return, and payback analysis. Okay? Computing cash flows is separately done in 3 different circumstances. The cash that I pay for the initial investment, the cash I receive or pay out during the operations, during the life of the investment, and the cash I may be receiving when I unwind the investment and dispose of it. Now, depreciation and losses are not cash. These are non-cash events. But depreciation and losses create tax shields, and that's a positive cash flow. So remember this formula, that non-cash measure is a depreciation amount or is an amount of a loss. You multiply that by the tax rate, and that's a positive cash inflow for you, known as a tax shield. Bear that in mind. Working capital represents cash that's tied up in your business at the time where you make the initial investment, and then it's subsequently down the road released when you're done with that part of the business where the investment is working, and you get that capital, working capital back. That needs to go into the cash flow analysis. So working capital, not depreciated, but also not affected by taxes. It doesn't go down, that working capital, but doesn't have a tax effect either. It's just my cash in one place of the business versus another place. Then finally, on return on investment, while cash flows are key to net present value, IRR, and payback, cash flows are not used in return on investment measures. We use profit instead. Does that make sense? Good. Make sure those notes are clear for you. And you are in great shape on cash flows, which are crucial to the rest of our work together in this lesson, capital investment analysis and decision making. Great job.